Hello, my Teaser King family. How is everybody today? I am just fine. Just 1 second. Apologize. All right. So, as you know, we start with our gold. Gold is up to 28.76, up another $26. It had one pull down this week. We'll watch M Mcguire a little bit. Silver 32.22, basically even. Why aren't we getting silver up? Because they're still doing derivatives. But all that's about to explode. Gold at 28.76. Hopefully, we don't get China tonight because the market closes at 6 o'clock. So we'll probably be right in the 28.70 range by the end of the day. Now their U.S. is doing their little shorting. How stupid are they? Everybody's buying gold. It's short. It's limited. Price is going up. And the U.S., with their infinite wisdom, is shorting. What a bunch of idiots. Oh, my God. That's like betting against Mahomes. Yeah, makes good sense. All right. So M Mcguire had an interesting show I was just watching. It's only 45 minutes. It's just him, so it's a good show. And he gets into, he believes the gold price should get to 5,000. He believes it'll go to 3,500 now, but nobody's selling. Everybody's like us. We believe gold's undervalued, so we're not going to sell it. He says he sees it going to at least 3,500. We'll play the video. Going to at least 3,500. Nobody's going to sell it there because there's such a shortage. Everything coming from London to the U.S. is strictly to handle the derivatives, and they're already gone. People are waiting for it. It comes into New York. It goes into COMEX. And here's the Chinese and the Russians and the Indians grabbing it. So it's already gone. All that 400 tons that came in is gone. The reason for the delays, as we've said, is because it's got to go to Switzerland and go from 400-ounce bars to 100-ounce bars. And Switzerland does the refinery. So they take the 400, melt it down. Then they pop in the oven the 100 ounces, and that's what we get. And then that's what we sell. So again, that's what's happening. That's why the delay. It's very simple. And again, everybody's in a long line waiting for both gold and silver. Silver is about to collapse. Mark says he sees, it should break 50 soon. So it's today's a day where I think I'll run and go get 10 ounces of silver. What else can you do? So I think that's the point of it. And we're right all along. We know the Titanic is sinking. The dollar is worthless. So everything's gone, right? We get into Trump and his tariffs. They're just trying to. I don't know. If he does tariff Mexico and Canada gold, they would just go to Switzerland. So they wouldn't ship it into the U.S. They'd switch it to Switzerland. There's no tariffs in Switzerland. There's always a plan B and a backdoor. So that's what would happen. Hey, Pat. Well, gold's up $22, so it's not a bad gold day either. Silver's just even. It's up 7 cents, 32.30. But I'll show you the Mark Mcguire video, and then you'll get excited then because he's seeing it starting to jump. It's just there's too much demand. There is no silver, and they got to start selling it because that's what people who do when they take delivery. They actually want the silver that they're taking delivery of. So that's what we see happening. So it's all positive. Sorry, I'm eating, but I'm eating. That's what we see happening. So this is Mark Mcguire's today. Gold leaving the U.S. and Western value. Gold and silver flow east. And we know it's flowing east because they're the ones who are taking delivery from COMEX. We don't have any. So that's what's happening, which we already know. As far as inflation, I put up in my title, it can't be stopped because there's nothing they can do with the dollar. Inflation is not prices as we know. Inflation is strictly printing the money. How can you stop inflation? Once you print the money, the genie's out of the bottle. There's nothing you can do. There's only one answer, and that's come out with new money backed by gold. Either way, we win because we have the gold. This is why I suggest you buy physical and you get it now. So let's say you were in ETFs or an IRA that you didn't hold, or these PAGs, these crypto PAGs, and they hold the gold for you. Well, there's a shortage of gold. Are you really going to get it? Well, I know you're not going to get it in an ETF or a PAC. An IRA, it's not yours. And see, what they do is they just screw you. They say, well, sorry, we don't have any more. It's gone. And you go, what do you mean it's gone? I bought physical specifically. Well, no, you really bought an ETF or you really bought an IRA. You didn't really buy the physical gold. I thought you were storing it in a warehouse or in a safe or somewhere. Yeah, but we ran out. We needed it for ourselves, and therefore it's not there. So you're fucked, gold and silver. That's why you only have one option. You have to go to the store and buy it, or on eBay and buy it, or ST Bullion, or these other, or what is it, Arizona or Pinehurst or whatever, Liberty. Go buy it, buy the physical. That's your only option. You have to have it in your safe, in your hand. Hey, David, how are you today? You enjoying these gold and silver run-ups, I hope. I know we are. It's nice that we've been in gold since 1700. And I remember buying silver at 20, 21 an ounce. And I kept going to the guy at the store. Thanks for selling it so cheap. And then he looked at me and he had no idea. So he was clueless. So that's what we got. We just got it jumping. Um, Anything under 3,000, they're just going to keep buying. And then I think the new price that will be is 3,500, and then 5,000. And then that's until people start selling. So as in the case of the Super Bowl, you have the ticket, and then it goes to secondary market, and everybody wants it on the secondary market. And that's what we're waiting for with gold and silver. But at what point do you put the Super Bowl ticket on sale? Well, let's say you paid $1,000 for it, and now they're going for 5,000. Do you put your ticket out for 5,000, or do you say I want 10 for it? And it's all dependent on how badly you want to go, how badly you need the money. If it was me, I'd want the money so I can go buy more gold and silver. But with gold, I'm not letting it go. I'm not going to let it go at 5,000. So the way it's set is there is enough gold, but not at these levels. At these prices, nobody's selling it. Now, the central banks, I'm not sure I'll see them sell it at all. Again, using the Titanic as our thing, you don't want to get back on the Titanic. So if I don't want to get back on the Titanic, then what am I doing here? Right? So I don't really want to sell my gold for any fiat money unless it's a desperation that I have to. Otherwise, I'm not selling my gold to get back on the Titanic, which means to get back into fiat. I'm getting out of fiat. That's why I buy the gold and silver, because this is worthless. So why would I sell gold? Even at $5,000, I'm still in this. So it behooves me to just hold it until I actually need to sell an ounce or something. That, like I said, my credit cards are high because I bought gold. Well, okay, so if I need to pay a credit card, I can sell an ounce of gold that I bought at 2,000 for 5,000, and then easily pay off the credit card. So that would be the idea. If something that you're going to pay immediately, and it's just with 1 ounce, but most of it you're holding. David, I was watching RFK. I guess he is going to be on the health board. I don't know. I kind of don't know what to think of these politicians, because the fact is they're all corrupt. They all take the sanctions. Are they going to be better than the Democrats? You think they should be. So we'll see. Again, he's got the JFK and the RFK bloodline, so you think he's going to be good, but he's a politician, so we don't know. Gold is king because you can't inflate it or print it. So let's be very clear why gold is king. Well, you know it's king because you can't inflate it. They can't just come up with more of it. There's not enough people that own it that they would try to get it back. Even taxing it, I don't know. It's not expensive enough. They're going after Bitcoin to tax. That's what they're going after. And people are going into Bitcoin because they think that's gold. People are out of their fucking minds. But this shows you how not stupid people are, how ignorant they are. Well, how they don't know, and the bad choices they make when they don't know. Who do you trust? They're trusting the Joker. They need to trust Batman, right? So why would you get into Bitcoin? It's limited to 21 million. Really? Are you sure? I don't think you're sure. Even if it is, it's not real. It's just digital bullshit. So if you have Bitcoin, you don't have anything. And this is the problem. They say, "Oh, it's up to 100,000 or whatever. Now it's up. Now it's down to 90,000." We don't really know what the value is, and since we can't hold it. We don't even know if we really have it. We have a wallet that says we have, but we don't know that we have it. What if the wallet goes to zero? Who do you complain to? When the dollar loses value and the Bitcoin loses value, who do you complain to? How do you get out of it? What if you can't get out of it? What if you try to sell it and they say, "Oh, there isn't any Bitcoin to sell"? And then you try to get to your bank and it goes into the bank and it never comes out of the bank. The bank says, "Thank you. Since we're not getting paid on our commercial real estate loans or our other loans and the stock market's crashing, we don't have any money. So we got to keep your money." So there's 18 different reasons why you should never be in Bitcoin, mostly because you don't even know what it is and it's not real. But they're using that instead of gold because it's at 100,000 and gold's at 28. And then ask yourself, well, why is gold kept down, but let Bitcoin let rise? Wouldn't they keep Bitcoin down? Because Larry Fink's doing the derivatives, he could just as easily keep it down. Bitcoin is not good. Yes, exactly. Bitcoin is not real. We don't know what it is. I mean, I'd rather have the Mahomes card. At least this is real. I have it. I know it's a 50 count. It looks gem mint, even though it's not created yet. It's still a 50 count and it's Mahomes and I have it. That's the whole difference. You hold the Mantle card, you hold the Rolex, you hold the Van Gogh painting behind me. It's a poster, but you hold it. You hold the gold, you hold the silver. The possession is critical. And they keep saying, well, you got storage fees and insurance fees. Mine's in a safe. There's no storage fees. I don't insure it because I don't want anybody to know I have it. What am I insuring it at? It keeps going up. So, it's relatively safe. Nobody knows you have it. So if you keep it in the safe and you don't say, "Hey, I got it and here's my address," you're probably fine. Um, that's the key to it. So all these digital currencies are scams and cons. Crypto Queen, read up on her. She had billions of dollars for nothing, and she even said it's a fraud until the Russian mafia killed her. Everything is everything digital I've never seen be real. There's so many digital problems where people go to jail, fraud, that how can you trust it? How can you trust something you can't see and you can't own because there's nothing to own? I have a Bitcoin. Oh, let me see it. Well, I don't really have a coin. Then you have what? A computer module. You have a computer. What do you don't even have? What is it? It's not even like a piece of paper. What do you have? Yeah, but it's worth 100 grand. Oh, is it really? Says who? Oh, says Larry Fink. And he's not a criminal. Yeah, we should trust Larry Fink. But gold, you don't have to worry about. And you can see because of BRICS, everybody's getting into gold. It's very limited, but at least you own it. I can go to the gold store now and I can go buy some gold or silver. I think I'll go buy some silver and that's it. And you say, here you go. Here's some worthless paper and give me real money. And they do. And you're like, you just shake your head. And it's so cheap because they're selling silver at $32 an ounce. And you just sit there and you just laugh. Look for silver to start moving. My advice would be to buy silver now, a good 500,000 ounces, and just wait for the price. It'll move into at least 500 relatively soon. So you're buying a $500 an ounce item for $32. How can you beat that? Why is there not a line to buy it? And yet when I go there, he always has silver. Every time he's got silver. I just bought some 2-ounce silver Canadian maple leaves. $31 an ounce. And you're like, it's just, you can't believe it. And people have the wrong idea. Well, how can I take it to the grocery store? Well, how are you going to take this to the grocery store when it has no value? People can't see that the value's gone. They don't realize the dollar has no value. That's why you're buying the gold and silver. You have to get out of it. It's like spoiled steak. You have a steak, but you left it out. And if you don't cook it tonight, it's stale and you can't eat it. You got to throw it out. That's the dollar. It's basically stale steak that you you have one more day with, and then you got to throw it out, and it's at the throw out stage. But where steak I have to cook, dollars I have to get rid of. I can't cook them. I trade them and get gold and silver with it. So that's really what you're looking at, is getting out of it into gold and silver. And again, what we like about Mark Mcguire is he gives us a good he gives us a good here Mark's prediction and $3,000 gold and $500 silver. I think he says that. Gold leaving the U.S. and Western vaults for the East. But think about it. Why it's going to China and Russia. So all of a sudden, Putin's an idiot and he's buying gold, but he's stupid, or she's buying gold and they're stupid. The stupid ones are the U.S., who could get it real cheap because we're keeping the price down, but we're not buying it. Is Trump buying it? If Trump's not buying it, he's a dumber guy than I thought. And if he's into Bitcoin, you might as well say goodbye to the U.S. because we're fucked. If he's taking our money and buying Bitcoin, it's worthless. I don't know why people think Bitcoin has a value. It's worthless. It's not limited. It's not real. And I think, oh, we don't want to own gold. Oh, but Putin does, and Xi does, and India does, and South Africa does, and Saudi Arabia does. All these countries want to own gold, but yeah, they're all wrong. David, TK, you doing Super Bowl thoughts today? We can do it if you want. I don't like how politicians take money from the companies. I don't like how politicians take the lobbyist money, which I think maybe that's what you're talking about. Yeah, that's totally illegal. My comment on the Super Bowl real quick. I did a video last night just strictly on the Super Bowl and on football and on gambling and how to make money on investments. I did all that last night, but I do it live, but you go check it out. It's there to watch. My score is 30-27, Kansas City, because Mahomes will win the game. He's a winner. That's why we look at chokers and winners. Joe Burrow's a winner. Stafford's a winner. Hurts is not a winner. Barkley's a winner. And this is what we look at. And so my analysis is KC wins because of Mahomes. It'll be very close because of Barkley and Jalen, what's his name, from Georgia. I was watching something and they pointed to all the Georgia guys and they said there's like 6 Georgia guys on the Philadelphia defense. And I've been bitching about that, why the Lions don't take Georgia defensive players. And then here, Philly takes them all. And now Philly's in the Super Bowl with a great defense because 6 of them are Georgia players. And Detroit keeps taking Alabama players, and they're just not as good as the Georgia defense, as is shown. So I got 30-27 Kansas City. I've taken Philly in 7.5 with the over 42.5. Now, as I've mentioned, it's still 1. The spread's down to 1. If Philadelphia goes favored by 1 or 1.5, I would then take Kansas City as a dog, as we love Kansas City as a dog, plus 7.5 with still over 42. They're not going to stop Kansas City from scoring in the mid to upper 20s, and they're not going to stop Philly scoring in the mid to upper 20s, at least. So somewhere I got 30-27. I got a 57. It'll be somewhere in that neighborhood. And KC should win by 3. If KC gets up 10, Philly will score a late touchdown. If Philly's in the lead, Mahomes will win the game for you. But either way, we're taking the dog and we're going over. And I love both of those. There's really no injuries. You're in a dome. There's no weather. Both teams are outdoor teams, which it's very rare an indoor team makes the Super Bowl. I think very few have. Most of the teams, Kansas City's outdoors, New England was outdoors, Philadelphia's outdoors, Green Bay's outdoors. Very rarely do you have indoor teams. Minnesota, the Rams once, Cincinnati's outdoor. San Diego's indoor, but Denver's outdoor. Look for Denver to get there. So that's my synopsis on the Super Bowl. How to bet it. Forget the props. G was asking me about props. Like, do I think Kareem Hunt anytime touchdown? He says, not against that defense. Against that defense, you want to play Mahomes for a touchdown. One of the secondary receivers for touchdowns. I don't even know who's healthy. Mahomes, maybe an anytime touchdown, or how many touchdown passes. I don't really look at the props. Barkley, anytime touchdown, of course, but the odds are probably suck. The problem with the prop bets is the odds are terrible. You don't really know what the real odds are. When you bet the game, it's 11-10 is what it should be. So my teaser is 11. I bet 110 to win 100, or 330 to win 300. So I know and those are fairly good odds. I don't know what a prop odds really should be. Mahomes anytime touchdown. Well, what's the odds on that? Oh, well, it'll be a minus 250. Is that a good odds? Should it be minus 500? Should it be minus 100? This is why you can't play that. At least when you're playing roulette, there's 36 possibilities, because 0 and 00, red and black, and that's where they get you, is the 0 and 00 are green. So they're not an odd, they're not an even, they're not a red, they're not a black. And that's the whole thing with them. So you've got to realize that. But your odds. There's 36 different spots the ball can land. You can figure out your odds. And then if you're getting good odds, just like blackjack. Craps, the odds are against the 7. So you know what the odds should be. Baccarat, okay, it's either bank or player. Poker, you're figuring out the odds going, well, I got 2 pair, and the odds on him getting the straight, I always figure less of a suit, because I always figure on the deal, there should be 4 of each suit if you're in a 10-handed game, because they're dealing out 20 cards. So 4 suits. So there should be mathematically 5 suits gone already. And then if there's like 2 diamonds on the board, then there's not a lot of diamonds left. It's a lot less odds than you think, because you're going off 13, and I'm going, no. You go off of 10, not 13. Anyway, but the odds on them hitting a straight or a flush, and the odds on the 2-outer. I got aces, you got kings, you got a 2-outer, so your odds suck, basically. That doesn't mean you don't get beat. It just means your odds suck. So you want to know the odds. So again, the biggest key is the defenses, very even. They're both 18, and then becomes Mahomes again. Barkley, you got Kelsey helping him out. You got Hunt helping him out. Hurts is not a help. A.J. Brown's good. I'm not sold on Devontae Smith. This isn't Alabama football where the guys run wide open. So, but this should be a close game. So my score, 30-27. Kansas City. Mahomes will win. The only reason these other teams didn't three-peat, Lombardi did three-peat. So I don't know what the fuck people are talking about when they say, well, they didn't three-peat. They did. 65, there was no Super Bowl. What did you want him to do? And then he wins the Super Bowl in 66 and 67. Well, what did you want him to do? He three-peated. Why don't you credit Lombardi with three-peating? Do you not like Lombardi? Do you not like Green Bay? What the fuck is the problem? And then you get on, the Steelers got injuries in 70. They win in 74, 75, get injuries in 76. In 81, in 80, when Oakland beat Philly, they had, Mike Wagner retired, Joe Green retired, and you had some injuries. And then it's mostly the retirements. And then Bill Walsh retires in 1990. They win 88 and 89. And then you get into Dallas. Jimmy Johnson leaves instead of a three-peat. And then New England was just, they played such bad competition that, they'd win 2 in a row, but then they had injuries or had to play Ray Lewis or something. But it's not easy to do. But the coach is still there. Mahomes is still there. You really don't have injuries to Kansas City. there's no reason they won't three-peat. But I don't even care about that. It's a hype thing by the media. It's bullshit. What you look at is they they're the better team in the Super Bowl. Philly looks good beating Washington. They barely beat the Rams. They were struggling in that game, and they struggled in the first game. Again, well, they beat Green Bay 22-10, which again they struggled, only getting 22 on Green Bay and only getting 28 on the Rams and 7 sacks. That ain't my team. So you can sack Hurts. He's not that good. And again, it's all Barkley. So look for Barkley. They'll key on Barkley, make Hurts beat him. But you can't really take Mahomes away. So the short of it is take Kansas City 30-27. If it goes even or Philly goes 1, it's very strong play on Kansas City and the over. As it is now, take Philly and take the dog and the over is basically it. Hopkins might be a good bet. Hopkins. Oh, on Kansas City? Yeah, that would be a good one because they're going to take Kelsey away. So I could see Hopkins. But I would think, I don't know what the prop is on Mahomes to throw a touchdown, or really he'll run in touchdowns. He's very good at the goal line, very nifty. So it wouldn't be surprising if he scores. But Hopkins, yeah. Again, you're going to get in the upper 20s. So you're going to get at least three touchdowns for both teams. And so that's how you got to play it. But I agree with you. Yeah. See, that's the thing. You kind of forget about him because it's Mahomes and Kelsey. But I told her not to play Hunt. It's a hard play because you're just going to hand it off to him at the 5. He's not going anywhere against Jalen Carter and the rest of the Georgia guys. You're just not going anywhere. It's just, you can't just run in on a handoff. So you got to run in. It's going to be Mahomes on a run in, or hit Kelsey who scrambles open, or Hopkins who gets in, or one of the other, the third tight end who nobody covers. Again, the Dave Casper play, which apparently only the Oakland Raiders were smart enough to play, where you fake the run into the line and everybody's playing run, and Dave Casper just, hey, I'm open. And I've never seen a play not work with Dave Casper, and I don't see it very often here. I think the Lions ran it once this year. It's a play I'd run every time I'm down there. 2nd and 2 at the 2, play action pass. My tight end fell down, got up, crossed over, and it was wide open because everybody's playing the run. It's such a simple play, but this is how stupid the offensive coordinators are. You don't like how the politicians take money from the companies. Yeah, those are the lobbyists. I don't know how it's legal, because then it puts the politicians in a position where they just do what the companies want them to do. You see it with the military teams. They give the guy $1 million. Yeah, we'll have a war in the Ukraine, and we need more shells. We need tanks and planes. It's such a strange industry. Well, we'll make defense. We'll make jets and rocket. We'll make Tomahawk missiles. Who the fuck thinks of this? So who's our customer? Well, we have to have a war to have a customer. I mean, you're just like, this is insanity. And then they go pay off the politicians and have a war. Well, I love this war. We'll fight Russia, but we won't really fight them. We'll have Ukraine fight them. What the fuck is that? So, I mean, that's the insanity of being a defense contractor or military contractor. Absolutely insanity. So, yes, I agree with you, David, that the whole thing should be not even available. It should never have been available. It's like Congress getting stock tips from the Federal Reserve saying these are the stocks we're going to buy, and then all these nasty Pelosi's put their money in those stocks, and then the Fed prints the money and the stock goes up. What the fuck is that? Insider trading is illegal. Why is the Fed or the Treasury buying stocks? That's not what they're supposed to be doing. So the whole thing is so corrupt. It's just ridiculous. I don't like Elon Musk in the government. He's not elected. I don't like him at all. I think he's an idiot. He makes electric cars, so nobody wants them. He doesn't understand economics. What the fuck do I want this guy for? His Twitter's in trouble, losing money. And I don't think he's a good businessman. I think he just has an accent, so people think he's smart. I don't know. I'm not buying it. So anyway, I don't like any of that. This is why we get out of the whole system. We take the white pill or whatever in the matrix, the blue, the red, the green, whatever the pill is, and we go into gold. And then we see very clearly all this corruption, and we don't give a shit about it because we've gotten out of it. We're sitting there with our gold as they ruin the economy and they ruin the dollars, and the dollars have no value, which is why I said you cannot ever get rid of inflation. The only way is to come out with new dollars or gold-backed dollars. The US dollar as we know it is worthless, and it can never have a value because you printed 160 trillion of these things. The petrodollar is gone. Saudi Arabia doesn't even want dollars for their oil. They want gold for their oil. So they'll still take them. There's the transition phase, and that's what's happening now. You can see gold going up. You see silver trying to go up. It's going up very little because they're trying desperately to keep it down because your Goldman Sachs and JP Morgan are going to lose their ass because they have all these derivatives because they're really smart banks. They're betting on the price of gold to go down when the demand's so strong. I mean, that's just a simple thing. You go to the grocery store and you see steaks at $10, $15 a steak. Why? Because there's demand for it. And things that don't sell, you see on sale. Those are what you short, the things on sale. You don't short the things that there's demand on, which is what they're basically doing. So you can't understand the mentality of these idiots because it's supposed to be a closed game. JP Morgan and Goldman Sachs just trade amongst each other in London, and they're trading the paper. They're not supposed to, the physical is not supposed to enter into the game. And all of a sudden, the physical is being bought off the game, and the game's collapsing. These guys have all these derivatives that they never worried about. Well, it's $22 for silver. It doesn't matter. But now everybody's taking delivery of the silver. They're fucked. They have to get out of their derivatives. They can't. It's going to cost them trillions of dollars. These banks will probably go out because the Federal Reserve is set up to the Federal Reserve, what a joke it is. So the banks sit there. That's like us betting football. And Bobby is our Federal Reserve. Bobby, I lost $10,000. I need 10,000. And Bobby's the Federal Reserve. Oh yeah, professor, here's 10 grand. And then David goes, I lost 5 grand. Yeah, okay, here you go. Here's 5,000. So Bobby's our central bank. And if we lose on their bets or playing poker or whatever, he just reimburses them. That's how stupid the central bank is. No, if I lose, I got to pay. And if I can't pay, I got to stop betting. So the banks are all fucked. The banks go to the central bank and say, give us money, and they bail them out. The central bank was put in by JP Morgan to, assist the banks when they make stupid decisions. That's the problem. So that's what the central bank really is. It's a bunch of bullshit. And the banks who fucked up with the housing crisis, they didn't lose. Meanwhile, all these Madoff people and all these people that got killed on the housing attack on Wall Street guy lose their ass. They don't get reimbursed. Even better is the Madoff people who won had to pay it back. What the fuck is that? I know you won your bet, but you know, you got to pay it back. Excuse me, I got to pay it back. I made a bet. I won it. I had a risk. I could have lost it. Why would I have to pay it back? I thought that was the stupidest thing I've ever heard, especially when the banks get made whole by the bailouts. So once we are in gold, we don't have to worry about that shit. And they're fighting us. See, it's not that easy. It's not free market. It's not a Rolex or a Mantle card where the market controls the price. And as I show you, the Mantle card for a 1965 PSA 9 Mickey Mantle is 75,000. That's the market. There's no JP Morgan doing derivatives keeping the price at 2,000. It's free market. The Rolexes are free market, which is what should be. However, gold and silver aren't. So we're kind of fighting the JP Morgans and wondering and not understanding why the price isn't going up. And then here comes Putin and Xi on our side buying the gold, forcing the price up because they're going to buy it anything under 3,000 and soon it'll be 3,500. And they're just going to keep buying and buying and buying because they know it's very, very undervalued, as we do. When I go into the store, I laugh at the owner. I go, "This is great. You're selling me $20,000 an ounce gold for $2,000. I couldn't be happier." Or silver. I'll go buy some silver today. You're selling me $2,000. Let's say $1,000 an ounce silver for $32. You know, it doesn't get any better than that. So. That's what we know. But right now we're fighting JP Morgan and Goldman Sachs because they want the price down because these idiots that shorted it. But then they're realizing they can't get out of it. It'll never go down. It's being bought, which is then creating the price to go up. And that's where we're at. That's why it's taking a while. That's why silver's stuck. Yes, we know the supply is gone. We know the demand is huge. We get that. And in a free market, it should be $3,000 an ounce. But we don't have a free market. And that's the problem. We have a fixed market by these people. So that's really the problem. And until we get that fixed, there's nothing we can do. All right. So I think we got that. Any other questions, comments? Feel free. Let's go to Mark Mcguire. So gold leaving the U.S. and Western vaults. Let's check in with Mark.
Shane, it's brilliant to have you here, my friend. And so we're back in business. So Shane, yeah, thanks for collecting these questions and getting them all organized. But in a nutshell, and there's a lot of confusion about this, but while tariffs have actually served to expose just how undersupplied the US gold and silver coffers are, it's the aggregation of all of the tonnages of gold that have been flowing east that is ultimately responsible for causing local London shortages. They're talking about this for specifically all the way through 2024, is the amount of gold that is just exiting the West. And as we indicated in our last episode, the liquidity providers continue to affirm that gold priced under $3,000 is perceived just way too cheap. So what we're going to look at is, while this gold continues to flow on a one-way journey into physically settled Eastern vaults, the US is now competing to also secure physical bullion to back the huge imbalance evident in the fractionally held stocks, gold stocks, which are now being, and when I say stocks, vaulted stocks, which are now being demanded actually for physical delivery. Now, while late to the party, this gold is needed to address an inevitable gold price reset. Now, we're recording this on the Wednesday the 5th, and every 2 weeks we do this market update. So, and so really, this is Wednesday. On Monday, on Monday morning, we woke up to the risks, the evident risks of paper to physical exchange for physical spreads, i.e. the price in the COMEX versus the price in the deliverable spot markets. We notice these EFP spreads are at risk of instantaneously expanding to unknown levels because it only needs one comment from Trump and it's on, it's off. It's so volatile. But when they expand, what we're seeing is it's getting ever closer to tripping off, really, it's so extreme, a series of bid-only COMEX market halts. And there is circuit breakers that could trigger that. Now, potentially, that's exposing the intermediaries to unlimited losses, i.e. the guys that make the markets between spot and futures. And I guarantee one thing, every single trading entity compliance officer has now shut down this risky trade. This leaves the Fed and the Bank of England to make markets. And given that the foreign exchange spot markets are NSFR delivery compliant, the gold price has to be reset at a higher price. Now, by their own admission, and as reported in Reuters, the UK through the LBMA and the US through the CME, so UK LBMA, US through the CME, they are liaising on the large EFP spreads with the panicked LBMA trying to disingenuously spin that London gold stocks are not only liquid, they remain strong. And we'll dig into that in a minute, but in reality, as every central bank, sovereign and institutional facing massive delivery market participants, they know they're facing massive delivery delays. And they know the massive paper to gold, physical gold imbalance. It's revealed to them on a day-to-day basis because they're facing now, in some cases, up to 12-week refinery delays and unprecedented over 10% lease rates to borrow central bank gold. Now, if this was just an LBMA CME issue, if it was siloed as it was historically before the physical markets were being settled outside of their little ring fence, then the paper-to-paper abyss, which it is, could be papered over long enough to allow these 10 to 12-week 400-ounce kilobar, 400-ounce refined to kilobar refinery backlogs to catch up, because they would simply just flywheel the paper until it caught up. Now, such is the spin from industry apologists. That's what they're telling us. But the these Western blinkered assumptions, which we're supposed to buy into, that there are dealers standing for delivery in New York, and these guys will ultimately end up with an oversupply, an imbalanced oversupply in the US. They're trying to spin that versus an undersupply imbalance against undersupplied London. That is disingenuous and completely false. What New York dealers are facing is the realization that the usually cash-settled COMEX EFP mechanism has become a gateway to actually obtain undervalued US gold. And it's headed east, which is not what they wanted. And we have direct evidence, actually, of two dealers acting as central bank sovereign proxies, having taken physical delivery of their full 6,000 lot maximum amount of positions you can hold on the COMEX, which is 18.6 tons, taking delivery of them, of the full allowances that they're allowed. Now, they not only saw that in the January contract, we've also seen it in the February contract already unfolding, as well as having secured April gold to their maximum allowable allocations. In other words, these are not going to be cash settled contracts. They are leaving the COMEX. Now, clearly, these are not the only dealers standing for delivery of their 6,000 lot allocation. The point we're trying to make here is that in the US, the US stocks are actually being openly targeted. And also, every morning, 5 a.m., we make calls around the Asian desks, and it reveals the RBMA CME attempts to counterintuitively tamp down gold. We see it on a regular basis. They're fully anticipated and very short-lived into offsetting reports of very, and I mean very strong central bank sovereign and institutional physical gold and silver demand. Now, while the Bank of England and the US are doing their utmost to gloss over their attempts to repay underwater gold leases, gold has now PM fixed today, just now, seventh time actually, above all-time high NSFR compliant first tier physically deliverable spot gold at 2,800. That was breached. Today, Wednesday, we evidenced the first fix above 2,850 spot. This is where the central bank buy stops and bids live. Now, while tariffs had exposed the extent of the paper to physical imbalance, it's been the bullion flowing east that's caused the current global physical shortages. I cannot make that more clear. And as liquidity providers have consistently been reporting throughout all of 2024, any NSFR compliant gold FX fix or price sub 3,000 that is put on offer is going to continue to attract central bank sovereign and institutional first-tier capital bids. This telegraphs much higher fiat gold prices in all currencies, with dips being jumped on by a physically starved market. In fact, on aggregate, most first-tier liquidity providers now assess $3,500 by the end of the fourth quarter.
Hey Andrew, speaking of all-time highs, in our very first episode,
just now, seventh time actually, above all-time high.
I just wanted to go over that 3,500.
First tier physically deliverable spot gold at 2,800. That was breached. Today, Wednesday, we evidenced the first fix above 2,850 spot. This is where the central bank buy stops and bids live. Now, while tariffs had exposed the extent of the paper to physical imbalance, it's been the bullion flowing east that's caused the current global physical shortages. I cannot make that more clear. And as liquidity providers have consistently been reporting throughout all of 2024, any NSFR compliant gold FX fix or price sub 3,000 that is put on offer is going to continue to attract central bank sovereign and institutional first-tier capital bids. This telegraphs much higher fiat gold prices in all currencies, with dips being jumped on by a physically starved market. In fact, on aggregate, most first-tier liquidity providers now assess $3,500 by the end of the fourth quarter.
So what he just said in English, huge demand for gold, physical. The gold coming over from London is to pay the derivatives off. It is not anything to do with we're going on the gold standard. We're not smart enough to go on the gold standard. But all the BRICS countries are. How is that happening? And then we have anything under 3,000 they're buying. So look for $3,000 gold. Anything under, with the intent, getting to 3,500, if you can count that by the fourth quarter. And my whole premise about looking at technical trends. How could you fucking technically trend this? Gold's never been over 2,800. Now it's almost 2,900. Go ahead, technical trend. Where's it going? You have no fucking idea because there's nothing to trend. That's my point with technical trends, because it's paper money. The all-time high is in paper, not physical. So it means shit. The fact that it's 2,850, it's all a mirage. That's paper gold is 2,850. We do not know what physical gold is, but we know it's a hell of a lot higher than 2,850. 3,000 again is just a number for paper gold. Up to 3,500 is a paper gold number. Also, my point on physical, it's times 10. 3,000 is 30,000, because again, the paper's diluted by the derivatives, and it's only 4% physical and 96% paper. So how the fuck can you can't say physical gold's 3,000. You can only say paper gold is. Physical gold must be much higher, and silver. The demand is huge. It's all going to China. It's all going to Russia. It's all going to India. Why are they demanding it? Because they know the dollar's done. It's very simple. The boat's sinking and you get off the boat, and our boat is sinking and we're getting off the boat and we're getting into the lifeboat, which is gold and silver. And you can see it's clear as day that the boat sunk. All these people are claiming it. I don't care if it's 3,000. So they're not looking at the technical trend, which says, gold's, it was 2,000. That's it. Well, yeah, it hit 2,500. So, it should go back down to 2,500 because that's the technical trend. And people are going, no, the boat sunk. I'm taking it whatever I can get it at. And now we're at close to 2,900. Hopefully we'll be there. It'll be 2860, 2870 tonight. Maybe we get lucky and get 2,900, but I think next week will be 2,900. And you just keep buying. The difference is this in Bitcoin. Bitcoin's up because Saylor and Larry Fink are buying it up so they can sell it when it gets high. So it gets to 105, they're dumping it, and it goes down to 90. And then they're playing this little game. That's not what's happening in gold. Nobody is buying it to sell it. Nobody will sell it at these cheap prices. He'll say that a little bit further on in this. Andrew's market prediction and $3,000 gold. So that's what's coming up. So he's saying this is not a dump. This is not people buying it and then it goes up and then they sell it. That's stock market that you guys love. That's not even the real estate. Then you're just trying to get your 8% or 10% out of the mortgage out. This is strictly stocks and Bitcoin, where they play around, bid it up, and then dump it, and the price goes down, and they bid it, and then they buy it, and then they bid it up, and they keep playing the yo-yo game. Not in gold. Never has, never was. It's never really fallen. I think it went from 250 to 850, and then back down to 250. There was just no demand for it, but that was like 1980 or 1990, and the stock market was going through the roof because of Reagan's tax cuts. Okay, you had a different place to park your money. Now everybody knows the money's worthless. Where are you going to park it? Stock market? It's still paper. Oh, we'll play real estate trust. It's still in the paper. We'll play Bitcoin. It's still in the paper. You have to get out of the paper. And so this is not like a little Ponzi where it goes up to 2005 and then we're going to drop it. No, this is going to just keep rising. So let's get back to Mark Mcguire. And let's see what else.
Andrew, speaking of all-time highs, in our very first episode of 2025, you'd kind of gone out on a limb to say that we would see $3,000 gold for the first time in history by the end of the first quarter. Now, can you update us on what you're seeing now?
Yeah, let's sum up the action since our last market. I can't believe it's only 2 weeks ago, on the 19th of January. And most importantly, as you say, to expect as we head into what looks like $3,000 gold, likely to be achieved well ahead of the end of the first quarter estimate. Now, with refiners reporting between 8 to 10 week delays and actually as long as 12 weeks to obtain any size of refined gold bullion, the Bank of England is having to step in to lease gold to try and flywheel the massive supply deficit. However, these lease costs have risen by another 8% above where we were just 2 weeks ago. They're in excess of 10%. And while these Bank of England leases are 100% hedged with risk exposure of further higher lease costs, these are laying on the books of the central banks of basically the US and the UK central banks. And the BIS is long gold, and every other central bank is long gold. The only problem lays with the imbalance between the COMEX and the physical markets. Ultimately, the COMEX, as we said last time, has to become compliant at some point. So, yes, the LBMA vault statistics evidences there's 8,710 tons of gold supposedly available immediately, with about half owned by central banks. But the reason we're not evidencing much outflows from the LBMA of the non-owned central bank gold is because Eastern demand is so strong and the higher prices are being anticipated, which means very little of this gold is put on offer because they're expecting higher prices. At current prices, that is, there will always be plenty of gold and silver on the market at a fair price. It's not a fair price. The unprecedented physical shortages are actually telegraphing the physical supply-demand equilibrium gold price is significantly underpriced. And this is serving to drive more refiners, wholesalers to lock in NSFR-compliant FX gold to meet backing up orders at current prices. After rinsing imbalanced hedges into the expanding spot to futures market EFP spread, the Bank of England lease fees to borrow April delivery gold get reflected in the expanding spread, rising as high as $60.60 when gold approached known waiting central bank buy stops at 2,800. And it was an attempt to cap it from touching these buy stops. They tend to be at a round number. And when it crosses it, they've already got orders waiting to buy. And you can see the extent of that $60.60. I mean, that is COVID-like extremes. We haven't seen that since that time. And really, so what they were doing was just capping it ahead of its first ever upside breach of spot 2,800. And so we captured it here in this link. So let's take a look. Now, as we've been tracking, let's roll back to what we're talking about here. We're talking about after gold had been going sideways at about $2,000 for quite some time, gold broke up $800 higher after China threw down the Shanghai Futures Exchange COMEX attack gauntlet, as we called it at the time. And if you recall, into this spike higher, the industry apologists, just like now, they came out to say that this spike higher was an aberration, and yes, there was plenty of LBMA gold sitting at $2,000. So they suggested this was just to short it or stand aside before gold retraced back to this level. The truth is that if physical demand stays elevated long enough to defeat a historical monthly paper wash and rinse cycle, so in other words, you get a rinse cycle, but secure at a higher stair step, is because central banks tend to buy at round numbers. And once a central bank buys at any round number, there is no going back, which is evident by this series of higher stair steps into where we are at the moment. I'm just recording this on Thursday morning.
Now, what have we just witnessed? We've just witnessed a similar event to what we saw back in March 2024. And we've marked it on the chart, much as we marked that Shanghai Futures Exchange point back in March of last year. So now what's happened is these higher physically supported, central bank physically supported higher gold stair steps are going to continue to be anchored during 2025 at ever higher levels into an absolute minimum of $3,000 to $3,500. And while we will continue to evidence some continued defensive Fed pushbacks, and we've seen a few, but they're getting bought pretty quickly. And we saw that after an $800 rally into the end of the year. No big surprises here. What it did was get rid of all the froth and enabled gold once again to start to clean out any of this froth to start. And then each time underpinning itself at a higher physical support stair step. And that's pretty much what we saw. The Shanghai Futures Exchange sudden demand, what it did is expose the EFP scam. And tariff tail risks have once again exploded one more time. And as we evidenced into the $800 rise into October 2024, and despite throwing the absolute kitchen sink at gold into the end of 2024, we still evidenced a final close at the end of the year where the BIS squared its last positions, where the Fed squared its BIS borrowed positions at the end of December. And we still saw an over $600 final settlement into the 2024 close. So while it took the Shanghai Futures Exchange launch to expose the massive LBMA CME paper gold fraud in April 2024, tariffs have simply exposed the fact that there is not enough physical gold liquidity to paper over the fact that Western gold is no longer in the hands of the cartel, and the scope of any such paper-driven counterintuitive dips throughout 2025 will once again, as we saw in 2024, be limited to rinsing out an ever-dwindling group of speculators willing to risk betting for or against gold for that matter. And many of the momentums who have historically controlled up to 75% of all the unbacked cash-settled COMEX open interest, they left, anchoring their boat to Bitcoin.
Wow, Andrew, we're definitely living in exciting times. We're living in historic times. And given let's say the Trump tariffs driven volatility that we're witnessing here, and it's likely to continue for now, can you expand on what you're seeing in the physical markets here?
Yeah, so given the next layer of very large spot central bank buy stops at spot 2800 have been tripped off now, driving the least cost to borrow gold from the Bank of England significantly higher, further tightening supply, expanding the EFP spread to COVID-like extremes, but not in just a flash move. It's settling in to COVID-like extremes, because whereas during COVID it was refineries were shut down and that was it. But now we've got refineries open, but there isn't enough bandwidth to even refine the bullion that's on order. So we've got lengthening refiner queues. So that's why we're seeing these spreads. And what it's doing is drying up the offer to sell gold at current prices, that is, risking large market maker hedging losses, not evidenced actually since COVID shortages. And there's only one solution to restore gold market equilibrium. That's a gold price reset. While such a reset is already happening by stealth, if we experience a geopolitical-driven black swan event, a hard reset would likely be set for a weekend, would not be pre-warned. It could happen at any time. Given every central bank is exchanging debasing dollars, euros, pounds, yens, for bonds and first-year gold, further breaking deeply embedded historical inverse correlations that usually related to those crosses,
it's impossible to estimate a real fair market value, but likely 3,500 would be the lowest probable support, and several liquidity providers are now estimating it would take $5,000 gold before sufficient physical gold was put on offer to meet refiner demand and close the EFP gap. So to answer the subscriber's question, Shane, to shed a little light on the physical to paper market imbalance, one only has to look at some of the very recent losses that these official arbiters has had to absorb. The last of the delayed 1.9 tons of January lots were commanding a massive $122 per ounce over spot, settling at about $108. It was actually $108.60. And that was the EFP premium at the delivery point. Now, with confirmed reports of two entities, as I mentioned, having stood for delivery of their 6,000 lot maximum allowance, efforts to synthetically rinse out the central bank size positions during January completely failed. Now, liquidity providers affirmed these liabilities 100% lay in the hands of the Fed. Now, also, we saw 242 tons of expiring February open interest went into first notice on Thursday. And given we had liquidity providers' reports of several traders were also standing for a loadout of their $6,000 lot 18.6 ton maximum allowances, it was no surprise to evidence an unprecedented first delivery date record of 92 tons of physical deliveries on the first delivery day of the February contract. Now, given there was still an almost identical 90 tons still standing for delivery, it just telegraphed that these EFP premiums and high spot prices would remain elevated. And as of last night, which was Tuesday, 140 tons have actually stood for delivery, with 49.5 tons still waiting to be squared. Now, I suspect a good percentage of these yet to be delivered contracts are going to be afloat around as warrants, whereas the bulk of the 140 tons already delivered are headed east. So the expired February contract spread should have been zeroed at this late stage. Even here on Wednesday, it's still trading at evidencing a premium to spot. So again, to fully answer your question, Shane, bottom line, these widening EFP spreads in both gold and silver have exposed the unsustainable paper to physical imbalance and telegraph even higher prices. And bear in mind, China's only just come back into the mix, with our liquidity advisor reporting Chinese wholesalers were undersupplied and will be forced to pay large premiums to divert tight supply. Along with gold, every other currency in gold is rising. Also, CNY gold is commanding all-time fresh highs. No surprise there.
CNY is China. So what he basically was saying, he never shuts up. I try to interrupt. So basically, he's saying $5,000 would put it even. So that's really what the gold should be selling for to meet demand. So as we talk supply and demand, what is the demand for the supply they have? It's $5,000 an ounce. And that's go up because the demand will start to go as people start to get off the Titanic and look for the lifeboat. So the demand is going to keep spiking as people realize what's happening. Now, I would imagine people are seeing the gold price at $2,860 going, what the fuck's going on? Maybe we need to buy it. We've already played the game at 1,700. We've already known that's what's going to happen. And now we're getting, we're just getting the satisfaction of buying it at 1,800. It's at 20 going to 29. But it's not stopping. It's going to be 35 and really 5,000. But as it gets to 5,000, it'll go to 10,000 because then the demand starts pouring in and these guys do not have enough. And as he said at the end there, it's going from the paper market to the physical market. The paper market's leveraged, the physical market isn't. So you're going to be looking at some very high gold and silver prices. He's going to get into silver next. Where are we at? 26. So he's going to talk about that. But I think he starts talking about silver now because the other guy is always the big silver guy. But silver, look for silver to boom. Because as you're getting out of dollars to buy gold, you realize silver's the only other money, not platinum, but I got to check on that. I'm sorry. Let me make a note. Platinum was $1,000 an ounce. Let's see what it's at. Let's understand platinum. And that's what I do so well as I see it. And then I dig into it to understand it. Sort of like there's Luke Groner. And I kept trying to, somebody said Luke Groner, and I go, well, is he a Keynesian or an Austrian? And it's not relevant what he is, because if I say, is Luke Groner a Keynesian, it doesn't come up. Is he an Austrian? It doesn't come up. He's some weird economist, but he's a salesman, and he's into Bitcoin, and he's a macro economist. So really, he's a Keynesian, but it doesn't say that directly. But we know he is. So again, you don't want to listen to Luke Grombit. You don't want to listen to Jim Reichert or Rick Rude. Any of these guys you don't want to listen to because they're Keynesians. We don't want to listen to Keynesians. Keynesians are idiots. They don't get it, and they're not smart enough to realize probably shouldn't be a Keynesian. Keynesians are basically want the government to control the market. As we see, it doesn't work. That's what they've been doing with gold and silver. The government, JP Morgan, and Goldman Sachs have been trying to control it. They're the government. And so they're trying to control it, and it's not working. And now it's blowing up. That's what happens when you have government control versus free market control. So be very careful who you're listening to. But we're seeing $5,000 an ounce gold, but obviously that's still paper. And they're trying to diverse paper to physical. And China is now needing more physical. And the demand will drive, as long as you have free market demand, it'll drive the price up and up and up. That's why the Montana rookie card is $110,000, because the demand for the card, and it's very limited, pushes the price up. And then with the higher price, more people buy it because they go, oh shit, it's 70,000. I'm going to buy it. And then it's 80, it's 90, it's 110. That's why people are buying Bitcoin, because of the high price. The difference is Montana, you actually have the PSA 10 card, and Bitcoin, you don't actually have anything. And he's saying everybody's dumping to get into Bitcoin. Well, they're all going to get killed. I showed you Alligator the other day, and he's saying all the Bitcoin people it'll just go to zero. And yeah, we already know that. We don't want to be in it. And my friend who so eloquently yelled at me here for trying to keep him out of Bitcoin, I hope he comes back and then realizes that I was right the whole time. Now, if he's smart enough to sell it, that would have been fine. So if you did buy Bitcoin and you did what Luke did, Luke sold it, took his profit, and bought gold. He wins. He wins in Bitcoin. He gets out before it collapses. He goes into gold before it jumps. He's the double winner. That's what you do, but that's what you do when you play poker or you play craps. You play craps and you take out $5,000 and you play craps and it gets up to 10 grand. You get out because you know the 7 out's going to happen and you're going to get fucked unless you're playing 7 out. You're going to play the pass line and then the 7 out and you lose everything. And then your 10 grand goes to 5 grand. And so when you're playing a casino or you're playing poker or you're betting football, you quit a winner. If you start hitting some games and you're up, you quit. And then you wait for next week and then you go. You don't think you're never gonna Reds just gonna hit it roulette, or black will never hit. I mean, you can't be stupid. That's just not reality. All right, so we see gold 5,000 an ounce, but that's still paper. The paper to physical ratio is blowing up where they're gonna need physical, but as people see it, the demand grows because they realize, why is gold going up? Oh, because the dollar's worthless. Once they see the dollar's worthless, then everybody jumps into gold, and then 5,000 goes to 10, goes to 20. And that's where I arrive at my numbers. And silver will do the same thing because silver is money. And that's what happens. So this is what people don't get. They don't know about gold. They see it being kept down by JP Morgan and Goldman Sachs. They don't understand it. They go, that doesn't move. So they're only interested in the movement, not behind the movement, not what's making it go. This is their first mistake, right? So that's really what you have. So be careful with that. And let's go see what Mark says about silver.
Now, Andrew, talking about fair market value, we've had a lot of questions from our Live from the Vault community and our silver stackers about the silver's underperformance. Can you shed some light on what you're seeing here with silver?
Yeah, most certainly the action has been extremely counterintuitive because silver is in even tighter supply than gold, and well below its free float threshold that we looked at last time, and with unprecedented spot to COMEX EFP spreads as high as $1.46 per ounce on Friday. Think about it, $1.46 an ounce. Captured it here in this link that you're looking at here. And so that means that somebody, to the tune of how many contracts, we don't know, got caught out to the tune of $7,300 per contract. That was the imbalance. So the silver short squeeze, it's no longer possible to hide it. And while the March EFP, the current front month contract, which is going to settle at the end of February here, while the March EFP settled at about 94 cents per ounce, when the last 20 and a half tons were of last minute January lots got loaded out of the back door, COMEX fault, it was still at that level. Now it's reduced a little bit to around about 60 cents today, and we would expect it to contract. It should currently be around about 12 cents. Now, these expanded COMEX premiums have made, actually, most people don't realize this, but these expanded COMEX prices have made air freight viable. And we know that people are shipping by air now, getting to get their silver there in case tomorrow Trump says, by the way, Mexico is being tariffed, or Canada is being tariffed, or could be anything. We just don't know. So clearly the risk is you don't have the physical on site. Again, you've got a problem. So almost every liquidity provider is assessing a minimum of $38 in spot silver. And I mean talking about in short order. And the next rally leg, that is going to be the next rally staging point. A medium term, it's going to be impossible to contain silver below its all-time $50 highs. Now, we've been exposing the disingenuous club of LBMA CME paper market traders. They call themselves the professional trade. We've been tracking them very closely since 2008. And they're so deeply embedded in their synthetic bets that have built up over time. And their synthetic bets against gold, even into current shortages, they've driven the gold-silver ratio to 87 to 1. But it's perceived to be at a break point at this level, facing the tightest silver market since COVID refiner shutdowns. And with free float decimated below official threshold levels, this is because refiners are backlogged with more profitable gold orders, so they're putting silver orders right on the back burner. Makes sense. And what this means is they are only taking forward locked in foreign exchange spot orders for silver, and these will ultimately be put through for delivery. But as with monetary gold, even though silver is not NSFR compliant, when a buyer is locked into a monetary FX gold silver price, it's spot indexed at that price. They own that cross against the dollar or euro or whatever it is. And even if silver rises to, say, $50 above where you might buy it today at 33 or whatever it is, this buyer is hedged. He's completely happy to take delivery at $50, $100. It doesn't matter because he's locked in. And the point is that higher price won't make him sell it because he's locked in and he will take delivery. And this is the kind of setup in silver as a gold price revaluation is underway. Just think how a gold price revaluation is going to impact silver. There's going to be some bankruptcies out there. And the cartel's break point is actually $35, which would easily be run through, triggering a bid-only short covering spree that would obliterate the synthetic ratio bubble, ultimately exposing, really, people were going to start questioning, well, what should it be? Well, it would expose the real 10-to-1 ratio. I mean, I'm not saying that's going to happen because it's unlikely because we've got a more viable level. But I mean, but if you think about it, at 10-to-1, 3,000 gold would be $300 an ounce. But the aggregate liquidity provider estimate is that the ratio will close the gap to its 2011 33-to-1 level, which would value silver right now at this price at $90. Now, I'm not saying this is going to be achieved in one fell swoop. Of course not. But liquidity providers do anticipate a range of $50 to $200 an ounce once gold breaks out of its capped range.
Oh, that's incredible, Andrew, what's going on now. Last year, you were...
Oh, there you go, Luke, Bobby. 50 to 200. It'll get up to my 1,000 as it goes. The momentum. People see what I'm counting on is the panic, right? You panic, the Titanic sinking. Oh shit, we need a lifeboat, and the panic went in, and they all tried to get into lifeboats, and that's what I'm seeing. Once silver goes to 200, it goes to 5, it goes to 1,000. So buy your fucking silver at 32. It'll cost me, I think, $2 premium, 34, which makes me run out and buy 20 ounces right now because, well, I have others, but you know, this is the thing when I talk to people and they go, well, I don't have money for gold. Well, you do have money for silver at $32 an ounce. Don't tell me you don't have $32. How the fuck are you paying rent and eating? So this is the point. You're going to buy a $1,000 ounce of silver for $32. Well, it costs $34. I don't get what's so hard to understand that. Do you not believe that it's going to 1,000, or do you not believe the dollar's going out, or what is it that you're so infatuated by your 401k and your monopoly money that you don't want to be in real money and it's about to go up? It's a no-brainer. You can't lose. So this is what I just, you know, everybody that I know who's saying, I got a 401k, I'm fine. You just, okay, fine. Being stoic, all you can do is control yourself. You can't control how other people listen or react. You can only make your peace. Silver, 1,000 an ounce. Now you either listen or you don't. I can't control you. But if you don't get out of your 401ks, you're going to be fucked. And that I can promise you. So we will see. But that's, again, there you go. That's Mark. Now, again, it's not going to happen, but you'll be surprised how quick it happens, because once it starts to run and people start paying attention to silver, people aren't paying attention to silver. It's 32. Once they see it at 50, and the news is it's the all-time high for paper silver, not physical. And that's what I'm always saying. We don't know what the price of physical silver is. It's at least 10 times higher, but I'm going to say it's at least 100 times higher. It's at least 1,000 an ounce for physical silver based on how much demand there is versus how much supply there is. And that's basically where you get it from. And then as the price goes up, the demand goes up. Again, with the Mahomes card, once you see there's only 50 of these, the demand goes up because there's only 50 of them. Or I got the bonds card. There's only 100 of the bonds card. Now, if this guy didn't do steroids, this would be worth $10,000 easy. It's a very pretty card, and there's only 100 of them, right? This is a beautiful card. So that's what you're looking for, is the low demand drives the price higher, or the low supply drives the demand higher. Like in the Montana card, there is not a lot of PSA 10s. There's not a lot of PSA 10s Jordan. That's why Jordan's rookie's 500,000. He's a little more popular than Montana, but Montana being popular, there's not a lot. So it went and it drove up to 100,000. Do you really think there's you'd rather have the Montana rookie for 100,000 or gold for 2,900? I mean, give me a break. It's a no-brainer. All right, let's go on with Mark Mcguire a little bit more.
Focus on how the Fed having to buy back the gold that they borrowed from the BIS at significantly higher prices, and now you're kind of suspicious here on what they're really, if they're trying to hide just how wrong-footed, just how off-sided they've become here now. Can you share your insights on this topic?
Yeah, I think it's best to go back and look at what we drew attention to last year, to remind our followers where we marked on the charts the exact point where the Fed had borrowed gold and how in every instance they were forced to buy back these positions at much higher prices. So let's go back to the 4-hour more granular chart and take a look at what we've been witnessing. And using the Bank of International Settlements' own data, and 100% certain the Fed is the only central bank that has actually been seeking to cap gold priced in dollars from rising by borrowing physical from the Bank of International Settlements because they don't have it. So here are the points we drew attention to when the BIS swaps leases were added to or cut. And so now and this is, we see it here, 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 here. Note that they are closing, they're borrowing gold at lower levels and then having to pay it back at higher levels and then reducing their exposure at higher and higher levels. Now, yes, we saw a little bit of a pullback into the end of December, but actually we think something here was fudged. And our feedback suggests the Fed tried to double down to borrow more physical gold from the Bank of International Settlements to try and cap the rising New Year gold price, but got caught out by the spike higher in lease rates. Now, looking at the larger picture, it was no coincidence the BIS swaps report was delayed. Even by a day, this has never happened before. And by their own admission, the Bank of England and the CME are working together to manage the situation. And this failure to deliver that report on time suggested that the minuscule 3-ton reduction from 81 tons to 78 tons was actually fudged and had not gone unnoticed by foreign central banks, sovereigns, and global-facing institutions, underscoring our liquidity provider assertions that the joint US and UK LBMA COMEX enabled price suppression policies are folding. The EFP spreads telegraph the COMEX has to become Basel III compliant, or it's going to have to fold. There's too much to lose to fold. It's not going to happen. Raising margins to meet compliance will have to follow the US Treasury at least partly, or ahead of the US Treasury at least partly revaluing US gold reserves. Doing so will likely force an unwanted Treasury audit, because after all, if you're going to revalue gold, when was the last audit? In the 50s? I mean, it's ludicrous. Of course, no, it would have to be audited, but that would likely be dragged out long enough to buy time to go to market to buy back rehypothecated US Treasury gold. Now, revealing this vulnerability into BRICS central banks in particular, the PBOC, from locking in spot gold to exploit the buyback of these swaps is driving the price higher. They know what's going on. Of course they know. And no one really knows the degree of rehypothecation relating to this 8,000 odd tons of US gold. Of course not, because no one's audited it. Therefore, it's not possible to estimate how much gold has to be bought back at market to repay these double ownership positions. But one way or the other, EFPs have exposed the paper to gold abyss, and the offer price to sell real physical gold will rise to an equilibrium level significantly higher than the current paper prices, paper diluted prices. There's a massive gap to fill here. And up until the 1st of January 2023, Basel III compliance, spot gold, FX gold, had traded on an unallocated basis, like silver at the moment, and it was being largely cash settled. And as with every other foreign exchange cross, long or short positions could be cash settled amongst the LBMA market-making bullion banks, with only a tiny percentage of hundreds of tons of FX gold traded every day being ever physically delivered. And that's the mistake that they seem to think will happen now. This is absolutely them failing to grasp you're now dealing with a first-year asset class. And by design, the shuffling of unbacked paper gold settled inside the books of the four banks previously privileged to have gold, who do still have gold accounts at the Bank of England, was a legacy that really followed Nixon's removal of the dollar gold peg in 1971, where dollar-denominated foreign exchange gold could no longer be actually exchanged by foreign central banks for a fixed weight of physical gold. However, the removal of the gold dollar peg had not stopped foreign central banks from exchanging their unbacked, rapidly devaluing dollars for gold in the open market. So they were happy to pay ever larger premiums over the $35 treasury price. So in December 1974, the US Treasury moved to take control of the gold market by creating the synthetic futures settled gold contracts. And these highly leveraged cash settled gold contracts were opened up for trading on the COMEX exchange, joining cash settled silver markets, which had been trading on the exchange since 1933. And this move gave the Fed control of both monetary metals for this period of time, up until 2003.
Now let's pop onto the daily chart, and this is spot gold. It's not futures. This is spot gold. And after 49 years later, on the 1st of January 2023, everything changed. The Bank of International Settlements reclassified foreign exchange gold into a first-year asset class, reopening the window for foreign central banks et al. To be able to exchange over-the-counter traded foreign exchange gold, enabling the fulfillment of a guaranteed T+1, that means one-day delivery, NSFR physical delivery contract. Meaning gold was no longer the unallocated gold, had to be backed by physical if you wanted to take delivery of it. And this is when central banks just took advantage of that window and continue to do so. So really, by no coincidence, the reopening of the gold window followed the Bank of International squaring up the last 500 tons of over 50 years of accrued gold. And they did it right here, just 2 months before they did it on the 3rd of November. That was less than 2 months ahead of revaluing gold as a first-year asset class on the 1st of January 2023. Now, relinking the convertibility of dollars and all related foreign exchange crosses to physical gold instantly reset the global monetary system, but has to date been deliberately ignored by the Western mainstream media, while conversely being embraced by every single global-facing central bank actively capitalizing on the window to swap depreciating, devaluing debt-backed foreign exchange currencies for gold at the market price. And because spot gold represents one side of a global multi-currency foreign exchange cross, where, as with every other foreign exchange cross, one side is long, the other side is short, Basel III NSFR compliance provided the conduit to exchange the full global suite of rapidly devaluing unbacked fiat currencies for physical gold, deliverable into a regulated T+1 protocol. And we noted the implementation of Basel III as the inflection point where the Fed split rank from the Bank of International Settlements, propelling every other global-facing European and Global South central bank to also begin to move as fast as possible to back their foreign exchange currencies with freshly revalued first-tier capital gold. The only remaining outlying central bank is the Fed, and who, through control of the siloed non-Basel III compliant cash-settled COMEX futures exchange, alongside non-compliant ETFs and billions of dollars of bearishly structured, unbacked office OCC bets, which is the Office of the Comptroller bets, which are published every quarter. These guys have continued to single-handedly double down on their short gold, long fiat dollar bets, basically. And while these very clear counterintuitive price suppression footprints are obvious, physically settled Asian market buying, directly followed by Western unbacked paper market selling, is under this noise. It lays an unsustainable paper to physical abyss. It's exposed it. Unlike the SGE, where to open a long or a short trade, you have to own a specific numbered physical bar before trading it, the Fed only owns a fraction of the gold it trades. So they've borrowed BIS gold to try and tamp down gold, but what cannot be offset against fiat and really offset against the fiat settlement process and the actual dwindling open interest that's already evaporating out of the market, it actually forces them to actually buy back these leveraged bets at market, higher prices to meet NSFR T+1 compliance, further tightening up global supply while driving prices even higher. Now, this is when reality really bites, and is precisely what is forging the series of higher physically driven stair steps, each of which has forced the Fed to short cover borrowed BIS bullion at higher prices. And a final note on still unknown tariff roller. So while it's unlikely that monetary gold and silver will be effectively sanctioned, if it was to roll out, well, Canada and Mexico would simply reroute their gold and silver production to Swiss, UK, UAE refineries, alongside direct shipments to BRICS countries. The US does not have sufficient production to meet their needs, so will be unable to divert US production to assist in receiving global, in actually allaying global shortages. They won't be able to get it. However, and especially if there's a tariff on it, so it'll circle back and it'll come back to them without tariffs. However, as we're drawing attention to, the COMEX provides the window to access the US nation's gold and silver holdings. So unlike when the EFPs expand to even larger spreads over the spot global price, or the CME removes the EFP conduit, which they don't think they would dare do, US bullion will be drained. Either way, gold and silver is going higher. Now, the only question that remains is, are you coattailing what the global central banks are doing by protecting your wealth too with physical gold?
Of course we are. So you can see the gold's drained. So the gold coming in is going right to the derivatives. These tariffs will not affect silver and gold. People are realizing they need to get out of the dollar, and the gold and silver prices for all these deliveries are going to skyrocket. So I'm off to go buy another 20 ounces of silver, but I have a lot. So my advice, if you don't have a lot, go jump on the silver, get 1/10 of an ounce or 1/4 ounce gold, build your inventory, because you're going to be rewarded handsomely. There is no pullback. There is no... It's not the game that Larry Fink plays in Bitcoin, where it goes up to 105 and down to 91, and they make a bunch of money, and then they do a derivative up, and then they do a derivative down. They're not. That's what they do in the stock market. It's all bullshit. It's all Ponzi scheme. You don't do it in gold. There is no, oh, it's going to get revalued down to $1,000 and then back to $5 and down to $1. No, it's going. It's going to be 3, as he said. Then it's going to be 35 very soon, 5,000 probably by the end of the year. And when it really takes off and we really get a physical price and not this paper bullshit, then you're going to see it much, much higher. So just enjoy the ride. Here we go. You have a no-brainer. You cannot lose on this. And as I say, I buy it. So it's not like I'm not a tech on Wall Street guy. I'm not putting you in a real estate trust, but I'm not buying it. No, I am in gold and silver, as you know, and I suggest you get in it, as you can't lose in it. But the only thing you can lose is you can lose in this. This is all worthless, right? So if you hold this, you're actually losing money on it. So if you have $100,000, it's not worth anything. It's not worth. It'll be theoretically worth 100,000, but what is 100,000 worth now? Nothing. Tuna fish is $5 a can. Coke's $3 a bottle. So the 100,000's worth maybe 10,000. It's what it can buy, and it can't buy a lot. That's why it's not the prices of everything going up. It's that the value of the dollar is dropping, and we need more dollars to pay for the Coca-Cola and the Fritos because these are we need more money for that because the money you're giving us is worthless. So it's sort of like Zimbabwe and you needed a wheelbarrow full of money. Or let's go back to Germany, which everybody knows, 1923. Why did they need a wheelbarrow full of money to go to the grocery store and buy bread and milk? Because the money was worthless. It had no value. Even though you might have had 1,000,000 Deutschmarks, they weren't worth anything. So I think they're Reichsmarks. So that's the problem. They're not worth anything. And you're sitting there with 1,000,000 Reichsmarks, but you can buy bread with it. You need a wheelbarrow full of it. That's what's happening. But you don't see it. There's no mechanism to show you that the dollar is worthless except for prices at the grocery store going up. But it's not prices that measure inflation. So when they say 2-3%, it's bullshit. That's not possible. And you just have to know they printed 160 trillion. The petrodollar is coming back. All these countries are getting out of the treasuries that they bought, and they're all buying gold. So all you got to do is just follow the leader. Putin's buying gold. Xi's buying gold. India's buying gold. All the BRICS countries are buying gold. Professors buying gold. Maybe I should buy gold because it isn't just a coincidence. It's because they know you keep printing the dollar to nothing. And that's the problem. So the value it's like anything. If you make something and you make too much of it, right? It's sort of devalue. So if you're making like chocolate cake, but you put in too much milk, it waters it down. And that's kind of what's happening. So you've watered down the money supply. So now it's worthless, right? You flooded the market with dollars. We did that in diamonds, right? In China, a couple of weeks ago, I showed you that, where they flooded the market with these diamonds that were all lab made, and the price tanked, and it went down from $5,000 to $900 or whatever, or $90. And so that's what you've done there. You flooded the market with this, so there is no value in this. But they're not going to tell you that. They're not going to show you that. But when you go to the grocery store, you go, why are Oreo cookies $5? It's not. They didn't go up in price because this is lost value, and they need more. You need more dollars to buy the same amount of Oreos or Chips Ahoy or whatever you're buying at the store. That's your light into what's going on. What's going on to the dollar? Because they won't tell you. They'll just say, hey, the dollar is up versus the euro. Who gives a fuck? They both suck. This is not worth anything either, right? This euro, this buys you a pack of gum. This buys you nothing. So this isn't exactly a strong currency. They are printing this to zero. So if this is stronger against this, they're both crap. They're both bullshit. That's why you want to get into gold. They can't print it. They can't make it worthless. They can't flood the market with gold. That's why we're in gold and silver. It's as simple as that. And you've got to realize the dollar. So if you have $1 million in your 401k, you say, well, I'm fine. Because when the prices go up, well, I got $1 million. Your million's not worth anything. Maybe it's worth 100,000 going down, and then it's not going to buy anything. And that's the problem. So why you can still buy gold with this monopoly money. I can still go to the store and it's $34 an ounce of silver, and it's now $2,900 an ounce in gold, but he will still take the toilet paper for the gold. Well, get your million and go and buy gold, because soon he won't take it anymore because it's worthless. And it's happened over the Romans and the French and the English and the Germans and Venezuela, Greece, Sri Lanka, Zimbabwe, Argentina. It's happened 100 times. It'll keep happening because they don't get the concept. If you water down your money, it becomes worthless, and they don't get that. So don't think your 401k is worth $1 million. What is the $1 million worth? It'll buy you a set of golf clubs. Okay, so before you get killed, turn it into gold and watch gold fly up. And it's like, get out of it, get into gold. You'll make your money in gold and it'll be protected. And your dollar that's worthless will go out. It's as simple as that. All right, let's take a last look at gold. So that was Mark Mcguire. I'll change the title. And let's see what our gold's at. Gold's at 28.56, silver 31.98. So gold, the derivative in gold, they're still fucking around with the derivative in gold, trying to get the price down. It's bullshit. Doesn't mean anything. And again, nobody's selling. This is not a sell. So at 28.56, it's still bullshit. I don't know why they're doing it, because that means they're doing derivatives. They're doing put options to let the price down. Like they think that it's going to go down. I mean, that they're still trying to make money on options instead of just buying the gold, which they don't have. So again, this will end about 28.65 today. It's closed for the weekend, and then China gets it on Sunday. So you can see the pattern, right? It was good. It was at 28.60 until about 9 o'clock, and then it goes up at 10 o'clock to 28.80. So it goes up $20, but it's only up so they can take the derivative. So it's all planned. We're going to push the price up to 28.84. Then you're going to do your derivative at 28.84 instead of 28.61. The price goes down, and it'll settle at 28.65, 28.70. And then next week we'll get to 2,900 and then 3,000, because they'll just keep buying it. And as long as they keep buying it, and the U.S. doesn't have enough gold, so they will keep getting it from London or wherever. That's what they're doing, is they have to settle the COMEX because they're taking delivery. So they have to get the gold in to pay off the COMEX. And then the people buying it are China, Russia, and India on COMEX. And so it's called take delivery, and that's what they're doing. And then the U.S. was still trying to get the price down so they don't pay as much. Well, it ain't going to work because there's too much demand for it. Anyway, so silver, $31.99. I'm going to go buy probably 20 ounces. I pay $2 over premium, so 32 is 34. Fine. Anything under $1,000, it's a steal. So that's what we have. Again, Super Bowl. I got Kansas City 30 and Philadelphia 27. I've taken Philly in a teaser plus 7.5 and over 42.5. If by Sunday night, Philadelphia is favored, I will put a big bet in on Kansas City plus 7.5, and the over. The overs for sure. I'm taking the dog, but if you want to give me Mahomes as a dog, it's a better bet than Jalen Hurts as the dog. I don't want to bet against Mahomes, but 7.5 is okay. But if you're going to give me him as a dog, thank you very much. Then we'll make some serious money and turn it into more gold. So that's what you got to do. So be very careful. I think that's about it. I'm trying to not go too long because, I'm trying to get views And when I see something now, if it's Mark Mcguire or Egon and it's 2 hours, I'll watch it. Most of the other guys, I don't. They don't know what they're talking about. I can only take so much. I quickly look at the subtitles and see what I want to watch. But if it's the right person or if it's a football game, I'll watch 2 hours of that. So I'm trying to keep the time down a little bit. I don't think I'll do a football. Yesterday I did a economics and then a football at night. I literally got no watchers at night. I see I've gotten about 20 now. But so I like the interaction. So that's what's good. So David and Pat, Luke, Bobby, have a nice day. So that's about it. Go buy your silver. It's $1,000 an ounce you're getting for 32. I don't know what else to tell you. It's going to happen. It's just going to take a little bit of time, but it's, as Mark Mcguire said, and gold, just if you can still afford it, keep buying it. Keep buying and buying and buying. That's all I can say. It's a no-brainer. It's a 5,000 an ounce by by the fourth quarter, but it's going to be 3,500 an ounce soon. 3,000 for sure, happening very soon, and there's really no threat of it. This is a bullshit. It's already back to 28.58. So you can see they did the derivative. Now here comes the buying. So they're just waiting for the derivative to go. Then they can buy it cheaper. I mean, that's the thought process. Silver back to 32. So www.teaserking.com. You want to email me with questions that come up before. I'll probably do a show tomorrow morning. I'll touch a little bit of football. Then I'll do a Super Bowl one on Sunday, but we've already got the picks, but we'll look at injuries and stuff. And I did one on how to gamble last night, how to bet, how to gamble, how to predict what I'm looking for between casino games, stocks, bonds, gold, and football. So watch that. It's very enlightening. That's how I do it. That's how I win. That's how, it's just, you got to understand it and then go from there. All right, everybody. Have a great day. Take care. I'm off to lunch. www.teaserking.com. All right. Take care, everybody. And I'm going to edit my title.